Hello everyone, welcome to the 5th episode of Anakazi Banking Online Conversations. I'm your host today. My name is Dean Nathaniel Onyambu. I trade foreign exchange and interest rates within the bank, within the global markets unit. Our topic for today is the global and Zambian economic and financial market update. And I'm joined by our very illustrious National Secretary for the Economics Association of Zambia. He also carries the hat of our Head of Operational Risk within the bank, Mutisunge Zulu. Welcome to the show.
Thank you, Dean.
Welcome back, everyone. Welcome, Mutisunge.
Thank you, Dean.
It's been a very interesting 2020. Obviously, we've seen a lot of challenges within the global economy as well as the Zambian economy. Take us through what you have seen this year.
Thanks, Dean. So, from a global perspective, it's been evolution of risk from financial to non-financial, and never did we ever think that disease pandemic would, infect the markets and be at par with the 2008 financial crisis. If you look at quarter four, I'll take you to quarter four of 2019. You'll see that the risk ranking, we were more worried about Brexit, we were more worried about the US-China trade impasse on a global level and geopolitical tension that was manifesting in the commodities markets. But then come first quarter of 2020, disease pandemic just went to number one. So there was that feeling where risks had subsided, but then come first quarter of 2020, disease pandemic, and that just then crippled financial markets. Started in China, and if you look at the base metal markets, commodity markets, currency markets, and this has just infected the entire world. In fact, asset valuation has been a source of concern, and it beats the 2008 financial crisis, which is worrisome. It has shaped the way central banks are thinking. There's been enough stimulus coming from the monetary side and from the fiscals. And maybe just to delve into what we've seen in the base metal markets, I think copper, which is very dear to the world, which is a bellwether for economic pulse, actually gave up a lot of those gains, having opened at $6,300 a metric ton, and did slump to 4,334, and that's around March period, and has pretty much recovered. If we look at the crude markets, I think crude oil did even shrivel into the negatives. I mean, there's never been a history of crude markets that oil has gone into the negatives because of supply concerns, demand, aggregate demand, and growth focus. So the world is set to recede right about minus 5.1%, which was a revision by the World Bank, coming from a level of minus 3.5 earlier at the virtual spring meetings in April. You're much more closer to the FX markets globally. Maybe you could want to share some light on what you're seeing and how it's been so far.
I think it's very interesting. I sort of caught on to what you were talking about with regards to asset valuation. I think if you look at the equity markets at the moment, there's a feeling that they're a bit overstretched, particularly if you're looking at the US and some of the other more advanced economies. And there's a sentiment within the market that what's happening within the equity markets is not mirroring what's happening within the real economy.
The disconnect.
There's a disconnect there. And if you look at the underlying risks at the moment, if you look at the geopolitical tensions, for example, you look at just yesterday, you had 20 Indian soldiers killed in the Himalayas by Chinese troops. So you've got Indian-Chinese border tensions. You've got Hong Kong flaring up again. That's going to be an issue between the Chinese and the US and the UK. You also have the trouble in the Korean Peninsula with regards to the North Korea bombing the liaison office with their South Korean counterparts, as well as the fact that you've got that civil unrest in the US. And I think a lot of people have sort of forgotten that we had that US-China trade war and it's not gone anywhere. And there might actually be that underlying risk that we might see some tariffs being reimposed there.
Yes.
And then if you look at what's going to come in the second half of the year, a lot of businesses which had been shut down for 2 to 3 months, I don't think you can expect some of those businesses to survive. So I think there might be coming flurry of bankruptcies in the second half of the year. There's a recurring second wave of coronavirus. We've seen in China, for example, Beijing, they've had to close schools, they've had to do partial lockdowns. In the US as well, I think 5 states had their largest ever spikes in coronavirus cases. One of them is Florida. If you look at, we also have the US election, that's going to be key, particularly if it becomes a case of if the White House and the chambers of Congress are moving from the Republicans. The Republicans currently control the Senate and the White House, but if all those shift towards the Democrats, I think you might see an increased tax regime coming through there, which might impact businesses going forward. And I think also because you've got this coronavirus at the time when you might be going into the US election, I think something that we should watch out is potential litigation issues with regards to mail-in voting coming through in the US. But when you consider all these factors, I think it really does cement the fact that despite the fact that we're seeing some silver linings in economic data, do think that this economy, particularly equity markets, look overvalued. This economy does look like we're not really going to see that V-shaped recovery that a lot of people think is going to happen, particularly the equity markets. It's more likely going to be something of a W-shaped recovery, or even that square root recovery we were speaking about off the show. So for me, I think what you're seeing now, particularly if you look at the direction of the dollar, if you look at safe haven currencies like the Swiss franc as well as dollar yen, they've actually been moving sideways while you've had risk assets like some of the commodities and some of the equities rallying. And for me, what that suggests is what you're seeing is actually a risk-off rally rather than a turn. So what that means is that going forward, we should expect to see some downside, particularly, I think, in the equity markets. I think at the moment they're being really supported by the amount of money we've seen being injected by central banks, particularly the Fed, whose balance sheet has actually almost doubled since from March to June. But I think what our viewers would really like to know is what is happening on the global picture? How does it relate to us within Zambia?
Okay, so I guess this disease pandemic is global, so we're not immune from it as well, because if you look at the pattern of coronavirus infections, it was more like how the world is networked. Yeah. You know, the international routes, because of flights, people have moved the virus from one point to the other, and as Africa, for instance, we are not spared from the same. Economies have locked down and slowly coming down to Zambia as well. Our neighbors have been on lockdown. Our trade partners are in total lockdown. If you look at the likes of South Africa, they're running a lockdown as well. And the trade relationship between us and South Africa, 30% of our import bill is with South African products, and that then impacts the flow of goods, importation of fuel, for example. We always think that fuel comes through Nakonde, which is the Dollarization route, but then there are routes from Durban as well, the tankers as well. So our copper as well does get exported through that corridor. So because of those infections, and if you look at some of the infection rates, they were actually coming in through truck drivers that are ferrying commodities. So to some extent, you see our airports have been locked down. So that partial lockdown has actually impacted supply chain distribution. And if you look at the supply chain distribution, pretty much manifests in private sector pulse, which is now your purchasing managers index. If you look at our index, it's the lowest ever since that index started being tracked, and 34.3 is really, really low. And compared to our peers as well, all our peers are in negative territory. And maybe one thing I just want to bring out is that most African jurisdictions are going through similar pain. It's as though we could even predict what the outcome of monetary stimulus would be and any fiscal intervention. But what is very categorical is that fiscal issues were there even before COVID, and COVID has only amplified those fiscal issues. And maybe a question for you would be, talking about these fiscal challenges, before I get to the question, we'll talk about these fiscal issues, and then we also are coming from an energy poverty era where energy was an issue because of climate change resilience issues, and it didn't rain that much, and over dependence on hydro. And on top of that, hydro in itself, energy, if we look at fuel as well, Zambia had like, was it 3 increments like last year, and we've not had an adjustment to get any reprieve despite the kwacha price of oil being right about 40 to 42% lower, which we believe the Energy Regulation Board would have taken advantage of to then pass on benefits to manufacturing. So we are pretty much in a tight spot, and you could see that finance ministers across Africa through the African Union are now pushing for debt moratoriums, debt write-offs, and just to get that reprieve, because currencies, for example, have depreciated, and with a depreciated currency used to calculate debt to GDP, debt to GDPs are then through the roof for most African nations, including Zambia, and that's why this drive for debt cancellation is on, to have a little bit of breathing space so that funds can then be channeled towards other sectors that will then claw back some of that growth that has been eroded. But you being an FX and IR interest rate trader, how are you seeing this manifest in your curves, in the interest rates that you are trading, and in the exchange rate?
It's a very loaded question. I think just where we need to start from, I think, is something that you really touched on. The fiscal issues that we had predated COVID. And it's pretty much the same in the private sector. You mentioned the PMI was at 34.3. It's actually been in contraction over the last 15 months. So the private sector has been contracting for the last 15 months, which means that PMI has been below 50. The last 21 out of 22 months have also been in contraction. And if you look at the PMI, actually since the start of that data being collected in around March of 2015, 2/3 of the time, it's actually been in contraction. It's actually averaged around 48.4 from March 2015. And the big reason for that is, as you've mentioned, it's really about our fiscal structure. And that has played a part in impacting the private sector. We've seen an increase in government borrowing and government spending on the back of that. But there is a case that can be made that obviously that has impacted the private sector, particularly in the interest rate space. And that's what we saw pre-COVID. You had the elevation of interest rates. We had record highs at the beginning of this year. If you look at the 1 year, record highs, if you look at the last decade, for example, you had the 1 year going to north of around 30%. You've got your bond yields already above 30%. We didn't have as much divestment with regards to offshore players this year. And I think that was a saving grace for us. A reason for that is I think a lot of offshore players had already exited or hedged their positions with regards to what they held in government securities or with regards to dollar kwacha. But the pressure that we really saw this year was actually also before COVID.
Exactly.
So we had the problem of the fact that you had a lot of the agricultural demand for fertilizer and seed was concentrated between one period. And that's what pretty much led into that spike towards 19. We've since pulled back, not because the fiscal structures have improved, but because importation has come off. I speak about importation because private sector is not doing as well. As an importing currency, we import a majority of what we consume locally. But because business is not doing well, you've seen a reduction in importation. And that has really been the significant factor as to why we've seen a pullback in dollar kwacha with regards to less demand coming out of the private sector, as well as the fact that agricultural demand has gone out of the market for now, but it should resume at some point September into November.
Okay, Dean, just on that point, sorry to cut you short, but I'm very tempted to ask you a question that is FX related. So there's so much demand for foreign currency, which is dollars, and talking about agricultural demand, which I link to FISP, which is your Farmer Input Support Program, that gobbles quite an amount of dollars. But at the same time, you also have energy, because remember, we're net importers and we're importing crude. So these two are the biggest drivers, and then we also have debt service. Yep. But then, was it a week and a half ago, we saw a directive by the Revenue Authority to dollarize mining taxes. So meaning the mines are going to pay taxes directly and it will be in dollars over and above mineral royalty taxes, because mineral royalty taxes were being paid directly as the central bank was trying to show FX reserves, which have fallen to right about just under 1.5 years, which is 1.4 billion. So what is your view on what the exchange rate would be with this new measure?
I was actually getting there. It's part of the same narrative as I was building up to early on. If you look at the pattern of the purchases for dollars last year, so last year, if you look at the central bank purchases on the market, trying to replenish those reserves, as we all know, are being impacted by the external debt service obligations. Those external debt service obligations are around 1.5 billion this year. But we haven't seen a significant dollar purchases from the central bank. But like I mentioned, if you look at the pattern last year, out of a net $548 million, $430 million of that was actually purchased between June and October. So it does suggest that we could actually see that being ramped up in this period between June and October. And I think we have seen the central bank in the market at some moments trying to buy dollars, trying to boost those reserves. The thing about energy is going to be a concern going forward. I think it's very important that you've touched on the dollarization of the mining taxes, because if you have the mines paying some of those taxes in dollars, it does take away some of those important conversions that we see, particularly during the middle of the month for pay as you earn on water view.
Which provides support to the kwacha.
Which provides support to the kwacha. So dollarizing those mining taxes does theoretically take out a lot of dollars from the market.
Okay.
What you'd hope on the back of that is possibly some of that energy demand could also be diverted towards the central bank, and maybe even that agricultural demand towards the end of the year could be diverted to the central bank, so that the market doesn't find itself at some moments where it's completely deprived of dollars to actually satisfy customer needs.
So would it be right to say that because of dollarization, there is a chance that the FX market could shrink in size?
I think that's obvious, because you've taken out the conversions.
Yes.
The shrinkage is going to happen. If they also take out or they divert the energy and the agricultural conversions, market shrinks even further. But I think, for me, my concern is that I think we need to see the central bank at some point when the market doesn't have the dollars, at least trying to supply to try and diffuse some of that upside pressure that comes when the market is dominated by dollar demand, and particularly dollar demand coming out from the energy sector. But in terms of a range, at the moment though, I'd say that we're looking at a range of around 17.8 on the lower side to 18.4 on the top side. But what our clients should continue expecting is that dollar kwacha trading is going to be very, very volatile. If you actually look at the last 3 months, the annualized volatility has been around 18%. And if you compare that to the last 5 to 10 years, where it's been 14 to 17%, you can see that we're trading at the upper end of that volatility surface. And then also, I think an important one also to discuss with regards to currency is going to be Rand Kwacha. If you look at Rand Kwacha, we've moved from 0.95 to 1.05, and we're now in an upward trending channel, which has actually prevailed from somewhere around Q2 to Q3 of 2018.
Yes.
At that point in September, Rand Kwacha was around 0.667. But we've been moving high, and it does look like it's going to widen, particularly if we do see that the global economic climate continues to be somewhat of risk on. I think South Africa is going to be a better beneficiary of portfolio flows than Zambia, based on the fact that their structures is a little bit more preferred on the from the offshore perspective.
Is that the reason why when the lockdown was eased in South Africa, flow started going in as though South Africa was not even downgraded into junk status, but then I think the Rand had actually hit 16.93. It started to push up again. So does that spell any concern that we should be worried about from the trade relationship we have? Are we going to be importing inflation from South Africa?
I think that's already happening. If you look at the 1 year difference between where Rand Kwacha is now and where it was a year ago, it's around 21% higher. On the dollar kwacha side already, that's around 39% higher. So despite the fact that if you look on a month-on-month basis, food inflation, non-food inflation, food inflation was lower, non-food inflation has sort of stalled. I think the exchange rate effect is going to continue playing a part with regards to inflation on a year-on-year basis.
Okay. So Dean, if I look at inflation, inflation is linked to interest rates. When inflation is ticking upwards, then in terms of premiums above taking risk in government securities becomes a source of concern. But then we are in a growth suppressed environment. Yep. You talk about currency volatility, which I do pretty much understand. And will I be correct to say we should not be worried about food inflation, because if we look at what agriculture focused would be for 2020, already we focused that we'll have a bumper harvest, 3.4 million metric tons, and the other crop yields will still be in excess of what the estimates are. So I would like to get your views on what the focus is for inflation. And then secondly, I'm looking at other sectors. So agric is doing fine, but then mining is our mainstay. But then if I look at energy supply, stability of energy, with regards the mines as well, I get a little concerned because production seems to be going down a little bit. Yes. Because of disease pandemic effects. The mines have had to decongest, and so production is not as much as it should be. And at the same time, there are ore bodies that are running out of copper, the likes of Luanshya and all that. So I talk about that because I'm concerned about what will be collected in taxes, because I know that the Zambian FX market, the biggest players are the mines. So I would like to get your views on that affecting interest rate risks in totality.
I think you note very well that food inflation may not be a problem, but non-food inflation may be a problem. When you look at it from the FX perspective, as we mentioned, taking out those conversions from the market could find itself a little bit vulnerable with regards to dollar demand, particularly coming from the energy sector. So there are chances that you could find moments where you see that spike in dollar kwacha. And as we also alluded to earlier, there are some sort of underlying flaws there that might limit a significant appreciation of the kwacha. As I look at kwacha, actually, I like to look at this proxy analysis for kwacha. I like to compare it with assets where we are related to, or we have some correlation, and some asset classes which actually have an impact. I was looking at copper. I was looking at the dollar index against major currencies. I was looking at the dollar against emerging markets. And if you look at that, over the evolution of those asset classes over the last 1 year, and you look at what kwacha has done over the last 1 year, if kwacha had actually followed the same trajectory, we should have been trading somewhere between 14.6 and 15.8. If I look at the rand, for the start of this year, we were pretty correlated to the rand. I think from around January to around the beginning of May, kwacha and the rand were moving in the same direction. But then now you've seen a risk-on rally, and kwacha is lagging, not just the rand, but its other peers. But if you look at what the rand did over the last year, we should be trading at around 17.2. So if I look at dollar kwacha, even from a technical basis, it does look like we should be trading in a downward trending channel. But as I've mentioned, it does look like there's a significant flaw there with regards to, we may see a pickup in dollar purchases from the central bank, mirroring the pattern that was there in 2019, as well as the fact that you've seen this dollarization of mining taxes. And the impact on inflation, I think, especially from the rand perspective, I think that's where that non-food inflation element might mean that we might not see, even if base effects come into play, we might not see inflation falling off significantly. Might still be around 16 to 18% as we go over the next 3 to 6 months. Maybe falling off towards the end of the year. In fact, if you look at the central bank monetary policy, they only expect it to come back to around 8% at some point in 2022, if I'm correct.
Yes, they gave it a 2-year focus.
They gave it a 2-year focus. So inflation could continue being a problem. And I think for the consumer, you've got inflation eating into your disposable income. And if you connect that to your business pulse and your private sector activity, I think it's going to mirror what you're seeing in a lot of jurisdictions where I don't think you're going to see a strong rebound in consumer spending, mostly because the consumer is going to focus on priority goods and they're going to be very cautious with their spending.
Okay, and just on that point, Dean, where we talk about inflation, because most central bank models will then be thinking about tightening monetary policy when inflation is ticking upwards, but disease pandemic and public health has changed that whole analogy, where it's now become making a decision for a social cause and ensuring that there is growth back to claw back the eroded growth from these economies. I mean, if you look at 4 countries, there's Ghana, Kenya, Nigeria as well. If you look at their rate decisions and the monetary policy stance that they've taken, you'd see that most of them have eased monetary policy, even in times when inflation was actually ticking upwards. So those correlations that we knew pre-COVID are now dislocated. I mean, just like we were talking about the deviation between what's happening in the equities market and some of that stimulus that is taken. I mean, in times when COVID cases are actually going up, you see markets rallying where markets are ignoring as though COVID was not there. But we've seen a drastic shift over the last few days, and it's very confusing. Looked like a great time to actually do research around this. And
no, I think it's an interesting time to be in financial markets. I'll even go a step further. Modern monetary theory was not considered to be mainstream. It was considered to be some radical idea. But if you consider what the Fed did, paying money directly into households, that's pretty much a function of modern monetary theory.
Was that quantitative easing?
I think it was further than quantitative easing. We've moved into wacky theory or helicopter money. This modern monetary theory of where you've actually got the Federal Reserve paying people paychecks and trying to bypass the financial system with regards to actually getting money to the consumer to spend. And then also using some of those measures, also targeting employment. I think these are major parts of what modern monetary theory, which was considered very radical just a year ago, they're actually playing out right in front of our eyes. And then also, if you look at towards the end of I think the middle of last year, there was a very interesting article on Bloomberg with regards to targeting nominal growth rather than targeting inflation. Because when you've got low growth, even though you've got high inflation, when you actually end up increasing interest rates, what you do is you impact growth even further by reducing it. So they were saying that what you should actually be targeting is your nominal growth, because the high inflation, what is actually offsetting is the low growth. And I think that's the world that we're living in. But I'd like you to at least lead us into a conversation on what the central bank has done. You already mentioned that some of our peers across the African region, they adjusted their rates lower. We saw a significant move lower with regards to our monetary policy rate. I think we went from 11.5 to 9.25, 225 basis points lower.
All right. So thanks for that question, Dean. So what the central bank did was that monetary stimulus, which the analog is interesting, where it's a public health issue that is being sorted by the central bank. It's as though the central bank has, acting like doctors.
It's a health issue,
health issue by throwing money at it. Exactly. So the central bank, that's the Bank of Zambia, did cut rates 225 basis points. It was very predictable. I mean, 9.25%, that was the first ever BPR, benchmark interest rate. And they had that room, and of course it was against that dichotomy of inflation ticking upwards, and no one would ever think that they would ease that monetary policy. So a number of measures put in place, the famous 10 billion stimulus package, of which uptake has not been that much. I mean, it's just about like 30%, 3 billion has been taken up. And look, it's like a credit card. You only use a credit card in emergency situations. So that in itself, when it was announced, the first thing that crossed my mind was, okay, this is additional liquidity, which is pretty much expected in COVID credit risk environment. But then you have that liquidity. But then excess liquidity is inflationary. And before announcing of some of those measures like dollarization of mining taxes, that would have been against the currency. It would not support appreciation of the currency. And giving people liquidity would have meant a boost in growth, because there will be more imports, people will have more cash, and then that other part of inflation, which is your demand pull inflation, where the old definition of too much money chasing few goods would then kick in. And then they've also relaxed some of provisioning requirements and capital requirements as well, boosting digitization and constant presence in open market operations to ensure that liquidity conditions will then lead to financial stability. So I bet the low uptake has also contributed to the inertia for the yield curve to climb down, because we were expecting that the yield curve would then climb down, and then looking at the price, which was 100 basis points above your benchmark interest rate, that would then start to reduce the cost of funding. But that is not coming through as fast as it should be. And I'm pretty much thinking that's the reason why they said, let's just slash rates by 225 basis points, more like to give it a jump start. But then when you look at the monetary side, you also look at the fiscal side. But on the fiscal side, it's very clear that there isn't that much space. And that's why even the tax cuts that were there were only on medical issues, importing medical goods like ventilators and everything. And at the same time, maybe tax cuts on importation of ethanol, which is used to make your hand sanitizers.
In fact, if you look at the fiscal space, I'm glad that you mentioned there's not a lot of space there. If you look at the fiscus, if you look at the first quarter, actually, if you look at the Ministry of Finance monthly economic indicators, spending was actually down 34%.
Yes.
So that tells you that they're already falling short with regards to what they targeted to spend for this year. And it also corresponds to the reason why you're seeing a lot of aggression with regards to trying to pick up a lot of monies from the domestic market in the issuance of T-bills and bonds. It's also why you've seen an uptick in private placements. That was mentioned by the central bank as well. At their monetary policy, you've seen a pickup in private placements. So this is issuance of bonds off tender, so not in the primary auction window. But the key gist here is that the government, because there's not a lot of space fiscally, but they do need to spend on the social safety net, for example, they need to back it up with either raising money externally, which hasn't really been successful this year. I know we've spoken, we'll speak later about possible debt moratoriums or debt suspensions, but the real gist is that we haven't had a lot of success with regards to raising money externally. So a lot of the financing has had to be raised domestically. And it's not just this year. That has been pretty much the theme in 2018, 2019. And then this year it's just been made worse because we're in an environment, that disease pandemic environment that you mentioned. And when you actually relate that to the fact that you have seen liquidity pick up. You've seen that 3.3 billion being dispersed for that medium-term refinancing facility from the central bank. But you've also seen the central bank injecting liquidity through the 90-day OMOs at the T-bill rate, pushing in May. That was around 1.7 billion. So far this month, in June, it's been around 330 million. That's really that avenue that has really boosted the liquidity. And the reason we should really be seeing an aggressive move lower in that 9-month and 12-month rates, as you mentioned. And that 3-month heading lower, because that 3-month has been low for too long. But you're not seeing that pace follow through. And the reason for that is that you have that significant need for the government to actually borrow. And that has been translated to borrowing on the domestic market.
Okay, so thanks for that, Dean. And I see there's a risk skew towards shorter dated, higher yielding assets than fixed income and bonds. So it's as though it's very predictable that bond auctions will be deeply undersubscribed, but T-bill auctions will be fully taken up. So maybe one other issue that we need to critically look at is debt restructure.
Actually, I can speak about the longer end. I think when you're looking at the investor at the moment, some of the investors are looking at next year's August election, so they prefer to invest in the shorter end. But the other reason that you're seeing lackluster demand for bonds on the secondary market, at least for the larger part of this year, has been the yields in the secondary market have been lower, have been higher than the yields of the primary market. It's only now where the 2 years, the 3 years, 5-year bonds and the 15-year bonds, where they're pretty flat with regards to secondary market levels and primary market levels. But the 7 and 10-year bonds, I don't think you'll see significant bidding interest there going forward, because the primary market is just, the difference between where the secondary market is and the primary market is just too stark. So investors would rather buy 7 and 10-year bonds on the secondary market rather than bidding in the primary auction.
But still on that point, Dean, could it be that appetite is being shaped by what the country's fiscal position is? Earlier this year, we had a spate of downgrades where sovereign risk is now a concern and they're pricing it into the markets. And I know the secondary market is actually much more liquid than the primary market. So we get an indication of what offshore investors are perceiving the sovereign risks to be in Zambia, which still takes me back to debt restructure. Recently, French asset management firm, investment banking firm, that's Lazard, was hired to to reorganize
for
$5 million. Of course, that's 5 basis points compared to the total debt stock for Zambia. And you mentioned a very good pointer where there is political risks here and there. Next year is an election year, and that's why people are investors are choosing to lock up their liquidity in shorter dated assets, because it's very uncertain after 2021. I would like to get what your views are in light of Lazard reorganizing Zambia's debt, especially that this came out of, first of all, talks with the IMF, and then the IMF asked Zambia to reorganize its debt. Is it a good or a bad thing?
I think it's a fantastic thing. I think if you look at the success for Lazard in countries like Mozambique,
yes.
I believe Ukraine, they're doing Argentina now.
And
I think there's Greece as well.
Yes.
I think if you look at the track record for Lazard, I think it's very positive that we got Lazard on board with regards to restructuring our debt. I think the key focus, particularly if you look at the unwillingness of some of these Eurobond holders, not just for Zambia Eurobonds, but across. There's a certain unwillingness with regards to actually accept restructuring some of these Eurobonds. Some of them want to deal with countries on a bilateral basis.
Yes.
So, for me, what I think the government is probably going to focus more on is trying to restructure some of that commercial debt, particularly some of that Chinese debt. And I think we're looking at a period of around 6 months. I think getting Lazard is going to be pretty helpful moving in that direction. The only concern I have going forward, and I'd like you to comment on that, is if we do end up succeeding getting that Chinese restructuring, maybe it takes 6 months, so we get some reprieve next year where external debt service obligations are lower. Does it reduce the need for an IMF program?
Thank you, Dean. It doesn't reduce the need for an IMF program. It would be great to get a restructure in the next 6 months on the Chinese debt, because one, it gives a bit of reprieve, because those resources that would be channeled towards servicing the Chinese debt could actually be channeled to service the $750 million. Yes. And then talking about Lazard, there are always sweeteners with these entities that are taken on to restructure debt, because they have muscle to underwrite debt, which is where the misconception has been, because a lot of individuals think, yes, they can restructure this debt even on a local basis. I wouldn't want to belittle that an average Zambian economist or a financial analyst would restructure that debt. But when you are settling for an asset management firm or an investment banking firm to restructure debt or to reorganize debt, you look at technical competence, which is track record, because debt restructure is a very complex process. Yes. It involves a lot of travel, engaging private creditors, and there's legal fees and everything. And then 20% of it is usually financial muscle, the size of the balance sheet, because the sweeteners are, when you restructure debt, you sweeten it by saying, if I don't manage to do X, Y, and Z, I have the muscle to underwrite this debt, which is what is very silent and a lot of individuals do not understand. And I thought I should just make that very clear. But if that happens in 6 months, trust me, that information, the more positive vibes we keep getting, will price into the markets. Exactly. And our debt internationally will be priced better than it is right now, because our credit default spreads are pretty much wide. So, in a nutshell, there is a silver lining, and we remain bullish that come next year, we are confident that Lazard would restructure or part of Zambia's debt, and that would be a step in the positive. The good thing is taking that step to reorganize debt is a very good move. In fact, if this had been done 3 years earlier, I think right now it would have been a different story.
Yes. I think it's very important you mentioned technical competence. I just wanted to add as well, Lazard has the networks. It's got the relationships in place already to actually restructure the debt, and I think that's going to be a very big positive. So I like the fact that you've actually focused on that debt reorganization or debt restructuring, because the World Bank's ready to help. But they say we need the IMF to be on board. We need an IMF program. The IMF is ready to help, but they say we need debt restructuring. So everything is hindering on the successful reorganization of a part or our entire debt.
Okay, and just to mention one thing, Dean, is so should we successfully have our debt reorganized and we get into an IMF program? I know the figure that everybody links to IMF is like 1.3 billion.
Yes.
I don't know if it's increased or not, but 1.3 billion, just to be very clear, is not enough to solve Zambia's problems. But the benefits that come with being on a program
Yes.
is increased flows.
Yes.
This country needs flows to flow through the veins of this economy, and it will also help with repricing of our debt on international capital markets,
Yes.
which increases our chances of going to reissue debt if we were going to go for a Eurobond to refinance
Yes.
the existing bonds, because right now we can't even go into international capital markets because our
46%. You can't fund dollars at 46%.
You can. That would be
that's detrimental.
Exactly. So I just thought I should mention that piece to say getting onto a program will really open many doors, because right now there are investors that sit on the fence, but they will have that level of confidence to then pour flows into Zambia.
And I really appreciate that point, because that's what happened in 2017 in Zambia. We had yields rallying, we had the FX, we had dollars coming into the FX market because there was a premise of an IMF deal which never materialized. So if you look, particularly in the context of a world where you see balance sheets, the Fed, Bank of China, People's Bank of China, Bank of Japan, the balance sheets have expanded to greater than $23 trillion. There's a lot of liquidity out there that needs to find yield. If you look at our current yields, they're very, very attractive. But what's not very attractive is the fiscal position. So in a world where you see all this cheap liquidity based on this monetary stimulus that we've seen across the globe, it's a world where portfolio investors are looking for yield. An IMF program would be a very, very attractive entry point for a lot of these portfolio investors.
And then growth would get back to levels of where the 7%.
Easy financing of the budget, because you've got money coming in, you've got interest by offshore players in local debt. One of the reasons is that we haven't had significant offshore interest in local debt. Thank you, Mutisunge.
Always a pleasure.
It's been a very good discussion, and I think a lot of people will find it very, very fruitful. Thank you for tuning in. We'll be back next week for the 6th episode of Anakazi Banking Online Conversations. Goodbye.